to Lance-O-Pedia. This is the 2026 halftime report with Lance Browning of Income Solutions Wealth Management, Tyler Texan. Lovely outfit as always. You're the best dressed podcaster that I know every single time, man. Good to see you.
My wife thanks you because she's usually the one that puts all this together. So yeah,
They usually are. A well-dressed man. Behind every well-dressed man is a well-prepared woman.
That's it. That's it. Yeah, I struggle to tie my own shoes, man. It's pretty bad. But yeah, so Garrett, we're going to talk about our halftime report. So every year, gosh, for probably the last, 10 or 12 years, we've done a halftime report. So basically, we just want to talk about kind of where we've gone the first maybe 6 months of the year and kind of where we, how we got here, where we think we're headed going forward. So kind of want to do this, and this will be a podcast. Obviously, we're going to post this on the YouTube channel, on the website. This will also be a live event that I'm doing this week, doing a lunch and a dinner session as well. So everybody listen to this podcast, you're guinea pigs. So here we go. All right. So anyway, so your next slide, Garrett, is going to be the big four. And so every year we talk about the big four economic indicators and things that we really watch. So there's a lot of noise out there and a lot of noise within the narrative out there. We just want to look at some hard data here. Okay. So the big one, the first one's going to be corporate earnings or profits. We're going to look at the Fed's balance sheet. We're going to look at leading economic indicators, and we're going to look at the Treasury yield curve. We'll look at the yield curve, Garrett, to kind of give us some ideas of what's going on. So in your next slide, you're going to see an earnings season dashboard. All right. So now this is for quarter one that ended in March. Okay. For quarter one. All right. And you're going to see here the first quarter earnings growth up there, top left, EPS growth. Earnings grew 27.7 in the first quarter of this year compared to the first quarter of 2025 of last year. Okay. Earnings per share, 27.7% growth. Revenue about 11.4% year over year. Gary, that is absolutely screaming. I cannot begin to tell you how good of an earnings report card this was. And we're looking at probably 20% plus for second quarter that actually ends today. So really, really doing well. I heard a lot of commentary of people talking about, well, this is just another .com bubble. This reminds us of the .com late 90s, early 2000. And I disagree. I'm not saying nothing bad can happen. I'm not saying the market can't go down. I'm not saying you can't have corrections or crashes. But back then, I don't know if you were in the business back then, Garrett, but we didn't have the E in PE. We were told, don't worry about earnings. We're not worried about earnings. Don't worry about that. Worry about clicks. Worry about price to eyeballs. How many eyeballs are looking at this website? Well, that obviously turned out not to be true.
I don't mean to interrupt you there, but
no,
if I recall correctly, there wasn't even necessarily an S in P to S, price to sales. You didn't have to have revenue. All you had to have was an idea back then. Yeah.
Just put .com after it. You're good. You'll become a millionaire. Or a gazillionaire. Ask Mark Cuban there. So, but the thing is, I think now the difference is going to be these companies in the S&P 500, particularly the AI and the hyperscalers, Garrett, are printing money right now. They're printing money. So that slide, that big four is really, really encouraging. Okay. Your next slide, you're going to see the Fed's balance sheet. This is one we follow pretty closely as well. This shows the assets that are on the Fed's balance sheet, just the asset side, right? Following the economic collapse back in 2008, we all remember that. We still wake up in cold sweats in our business. The Fed began undergoing a series of what are called quantitative easing, or QE for short. Basically means the Fed is printing money borrowed to buy bonds from the U.S. Treasury, to buy Treasury bonds. And they seemingly do this to provide excess liquidity to the economy or markets, generally in times of great stress, okay? You saw a huge spike in assets on the Fed balance sheet right after the COVID pandemic. You see this big, huge spike, 2008 to 2009, this gray bar running up and down is going to be a recession. Obviously, that was a really bad one. And then you see the COVID recession, really bad, but very quick, about 6 weeks in duration. But you saw this huge spike in the blue line, the assets. You see a huge spike following COVID, and then it starts to tail off. One of the things the new Fed chair, Kevin Warsh, we've done a podcast about him as well. Kevin Warsh wants to reduce the Fed's balance sheet. This should be interesting. Historically, as the Fed increased its balance sheet, as its assets increase, there's a lot of correlation between the Fed's balance sheet and the S&P 500. We've talked about that in past episodes, but right now we're not seeing a lot of correlation there. So a couple of things, we're going to talk about something else as well, the correlation here as well later on, but that correlation seems to be decoupling a little bit, seems to be separating a little bit. So we'll see what that looks like. We'll see how the market kind of reacts to that. Next, you're going to see our leading economic indicators, LEI for short. And there's a conference board that does all of these things. It's a data crunching numbers geek organization that does economic analysis for us. And so you're going to kind of see here the blue line is going to be your leading economic indicators. All right. And so these generally will determine the direction of the economy, which typically will determine the direction of the markets, right? And so the blue line is the LEI. That's the index. Okay. Thing I want you to see, the blue line, of course, is going to be our index. Those great bars running up and down. And I can take this back to the late 90s. Those great bars running vertically are recessions. Obviously, dot-com bubble, 2001, 02 there, you see it. You see '08, obviously, that one was catastrophic. And then you see COVID. But the thing I want you to notice is prior to these recessions, you're going to see that blue line, the leading economic indicators, you're going to see a big rally up and camel hump as they roll back down. You saw that prior to 2000. You saw that prior to '08. You saw that prior to COVID. And then you saw one late 21, early 22 here. And so typically those camel humps are very, very good pre-recession indicators, right? Very, very consistently, camel hump recession, camel hump recession. Well, had a camel hump here 21, 2022, and still looking on that recession. So we have not seen that one yet. So you're starting to see some decoupling here a little bit from what typically are good economic indicators, pre-recession indicators, warning signs. You're seeing some decoupling there. So I don't know if that's good or bad thing. We'll let you all figure that out. And so your next one is going to be the yield curve. And so at the very bottom, you're going to see various maturities for treasury debt, treasury bonds, T-bills, treasury bonds, going from about 3 months, what we would call T-bills. That's typically going to determine short-term CDs, money market rates, that type of thing, savings accounts, whatever. They're going to be tied to those short-term 30-day T-bills, 3-month, 90-day T-bills, okay? And we go all the way out to 30 years. So vertically on the left, you see interest rates here or yields, right? And so typically, common sense is going to dictate that when you see, I guess, the longer you tie your money up, the longer duration of the instrument that you buy, typically the higher rate of return or yield you're going to get that you're going to receive on your money. So this is a pleasant surprise. This is a welcome change because for the last couple, 3 years, we've had what was called an inverted, or in Texas and North Carolina, what we call a backwards yield curve, where short-term rates were higher than long-term rates, okay? That is back to a normal curve. Now, typically, inverted yield curves signal recession. Very consistently, they signal recession. So far, that hasn't been the case. And then typically the recession actually happens, Garrett, when the yield curve uninverts and normalizes like what we've got right here. Still haven't seen that phenomenon. Now, a lot of concern about the Fed in raising interest rates. And if they raise interest rates, the short-term end of the curve goes back up. If the long end of the curve stays flat or goes back down, you could invert again, or this thing could flatten out. So I think that bears watching, but right now, this is a very normal yield curve. You make more money tying it up longer term. That makes a lot more sense. So we know that the consumer is about 2/3 of the U.S. economy, of GDP, okay? So that's an important thing, okay? And one of the conversations that I hear people talk about all the time is just the amount of debt that everybody has, how concerned they are with debt. Well, Lance, everybody has so much debt. Consumer debt is the highest it's ever been. And sovereign debt, government debt, as we're painfully aware, is the highest it's ever been too. So let's look down here, there to the on the left side where it says consumer finances, those two big stacking bar graphs. You're going to see total liabilities, consumer debts, $21.5 trillion. Garrett, that's a huge Massive, huge number. Okay. But here's the thing. That's the narrative. That's what everybody's saying. That's kind of the rumor, so to speak. And while debt is the highest ever been, look to the left side. You got to look at both sides of the balance sheet here. You got to look at assets and you got to look at liabilities. So liabilities, debt, highest ever been. What about assets? Consumer assets, 205.6 trillion. That's almost a tenfold asset to liability. Close. Okay. So if you want to just look at debt, yeah, that could get a little scary, but assets are very high too. Okay. And so upper right there, well, that talks about household debt to service ratio. I can go back to 1980. So I can go back 45, 46 years, and you're seeing that debt to service ratio, debt payments versus disposable income, actually doesn't look too bad. It looks better than it did in 1980. So the narrative is this is horrible, catastrophic. Really not as much. The data doesn't support that. So something to really continue to watch, I would say. And so let's talk about drivers of consumer spending. Okay. And earlier this year, Garrett, you'll remember we did a podcast on something called a K-shaped recovery. Basically, the theory behind a K-shaped recovery is that those on the upper end of the asset and income scale have the ability to spend more money and buy more stuff. Okay. Clearly, this makes total sense. If you see here, basically, right here on the left, the top 20% of income earners in this country are the lion's share of consumer spending. Okay. So you see this top 20% in blue, they do the lion's share of consumer spending. Top right there, you see that chart, the bar chart, which says consumer share of total pre-tax income and spending. You see that top 20% of income earners are about 38% of total spending. So that's very much skewed to the top of the ladder. Why is that? And why would that be the case? Well, we're going to talk about consumer confidence in the market. So I think the thing we see, and going back to the late great Alan Greenspan, Fed Chair Emeritus here, Greenspan talked about something he called, Gary, the wealth effect. You may remember this. So if people's homes, their stocks, their bonds, their mutual funds, their 401ks, if their homes and their investments are gradually, rapidly increasing in value, they feel wealthy, they feel rich. If they feel wealthy, they feel rich, they go buy stuff. And these tend to be bigger ticket items. Homes, refrigerators, cars, these types of things. Okay. So that matters. That matters. And that's the thing, Garrett, as prices have gone up, increased a little bit, certainly with the conflict going on in Iran, that's caused a big spike in oil prices, which fortunately are coming back down. But I think you're seeing that inflation component. So you have the wealth effect for folks on the higher end of the income scale. Their investable assets, their homes have gone up. They feel wealthy. They buy stuff. Towards the bottom end of that scale, that the bottom leg of that K that we talked about in the K-shaped recovery, they're feeling this. They're feeling $3 and $4 a gallon gas. They're feeling the pain of a lot of these things. So we'll look at inflation components. So let's talk about inflation here for a second. And let's look at what's contributing to end prices for the consumer. And so here in the right, you're going to see different colored codings, basically, for things that comprise CPI inflation, Consumer Price Index inflation. So the green is energy. Of course, we've had a big spike up in the green and the energy with the conflict in Iran. Clearly, that's the case, okay? After the Iran conflict started, energy prices rose substantially, and they did it very quickly. This contributed to a pretty good, at least we believe, temporary spike in inflation. Now, here's what's interesting to me, and this is kind of those decoupling things. If you look at the other components of inflation, one of the main drivers is the light blue here, Garrett, which consists of dining, recreation, and other services, okay? We're talking a little bit about consumer confidence in our next slide, but recently consumers have been adamant in their belief that things aren't going very well. Things are bad, gloom, they're quite gloom and doom. Even with this, they're still shopping, they're eating out, they're going to the movies, and they're going on vacation. And so they seem to have plenty of money to do fun stuff. And I find this really interesting. I'm not confident, but let's go to Destin for the weekend, right? And so I think there's very much a disconnect, I think, between people's emotions, how they feel, how they say they feel, and what they actually do with their money. And I think this ties into our next slide, consumer confidence. So finishing up discussion on the consumer, this chart's going to go back, Garrett, about 54 years to the early 1970s. And here's what's interesting to me. So when consumers do not feel confident, they tend not to invest in the market. And that's that wealth effect Alan Greenspan, we were just talking about. So the other thing that's interesting to me is historically, there's a lot of correlation between consumer confidence and the stock market. They tend to follow together pretty closely up or down. They're very historically tightly correlated. And you see the same thing. The black is going to be your consumer confidence. You see the same thing with consumer confidence and those recessions, those gray bars running up and down. You see consumer confidence spike, recession, confidence tanks. And so consumers haven't been very confident in the last few years. Obviously, I believe inflation, post-COVID inflation and then the Iran conflict inflation has caused a lot of that angst that they're feeling. But consumer confidence surveys are generally taken by phone or online. So people get they get a phone call, a text, an email, a message or whatever, and they respond to that survey. And that response generally is going to be driven purely by whatever emotion they're feeling at the time they take the survey. It's basically a snapshot of how they're feeling, that emotion right then in that moment. And so I just think it's interesting. On the previous slide, we saw how people feel, and then we saw what they did with their money. And those two are very different things. And I find that really interesting. And one other observation, last 3.5 years or so, the market has consistently been making new highs like every other day. So the market right now, currently, is making new highs while consumer confidence is tanking. Okay. This is really strange. And it also begs the question of where's that recession? Where's the recession? We've been getting the indicators, haven't seen the recession. Bears watching. Gold, one of my favorite topics. And I was doing a little calculating this morning. Okay. So speaking of things not making sense, Garrett, let's talk about gold. So some fun facts. Gold typically does better in times of uncertainty. For example, war. Okay. We see this, through the media blitzkrieg of advertising and marketing for these gold dealers, gold sellers. Gold also does best when real or inflation adjusted interest rates are low or negative, right? So ironically, real interest rates right now are actually pretty high. That should mean gold going up. Okay. So this meteoric rise in gold at the end of last year and beginning this year, we said, why is that happening? Why did gold have such a run up last year and into January this year? Okay. And it's interesting. So in January this year, gold had gone up. It reached an all-time high of $5,595 an ounce at the end of January 28th of this year. Since then, I looked at this morning before the market opened. Gold was about $4,039 an ounce. So that's a 27.81% drop in gold since the end of January. Oh, by the way, in the middle of a war, Garrett, that it just kind of blows my mind here a little bit. And if you really want to get depressed, silver from January 29, that big run up in the metals in January, to this morning is down about 51%. And you got to kind of wonder because, people buy precious metals because they're afraid the stock market's going to crash. Well, the stock market went up and gold and silver crashed. Interesting. Okay. And another fun fact, the price of gold actually went down after the Iran conflict started. Why is that? Just kind of, as we say, asking for a friend, right? Why are gold and silver so bad? This is one of my favorite slides, and we do this every year, but I think it bears repeating. I think this is one of the better pieces of data that I've had, okay? So if you've been watching our podcast, you've probably picked up that this is one of my favorites. Pretty obvious, okay? So what we're seeing here is our average annual returns in the stock market going back to 1980. So pretty long data set, Garrett, about 46 years, all right? So the black lines are your annual returns in the market, up or down, okay? These red dots down here represent the decline or drop in the market during that particular calendar year, what we would call entry year. Sometime during that calendar year, the market had a drop, typically, very common, okay? And you see the calendar years running kind of horizontally at the bottom. All right. So let's look right here at, let's say 2009. Obviously, that was really, really, really bad. Okay. And so, we're all going to remember 2008. My wife tells me I still wake up in cold sweats about it. But, 2008, Garrett, that was Great Depression stuff. That was bad. Okay. We went off the cliff like Wile E. Coyote. I mean, it was not good. And so to start 2009, the market dropped another 28%. So you had a 49% decline in '08. It finished down. The market actually went up a little bit from then, but the market was down 38% in '08. That was bad. Right. First round out of the cage, starting off 2009, the market dropped another 28% first quarter 2009. Okay. So the world's ending, right? I mean, that's what that's telling us, right? Well, if you'll look, go back straight above that red dot 20 minus 28%, you'll notice the market actually finished up 23% in 2000. Okay. That's a 51% swing low to, peak to trough. That's a big move. And so I think that bears watching going forward. And we'll talk a little bit about here. Let's go to COVID here. All right. So let's go to 2020. Find that one real quick. All right. So COVID. So from Valentine's Day 2020, middle of February 2020 to the end of March 2020, the S&P had a 34% drop, 34% in 6 weeks. Okay. Where I'm from, we call that a crash. All right. What happened for the whole year? Did the world end? We were being told on the TV clearly said we're all going to die in 10 minutes. Okay. Did the world end? No. What did the market do in 2020? Pop quiz. It was up 16%. From a low of 34%, finished up for the year 16%. So I think that, just something to really kind of keep in mind. And this shows a pretty consistent theme, this whole chart. Over the last 45 years or so, the stock market has averaged a decline sometime during that calendar year, intra-year, of about 14.2%. So sometime during the year, you're going to have, on average, a 14.2% decline. Last year, we had what I kind of call the tariff tantrum. Trump comes in and says, tariff, 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 tariff. And the market dropped March and April last year, 19%. We're doomed, right? World's ending, sky's falling, we're doomed. Not exactly. Stock market in 2025 actually finished up 16% for the year. So, and we saw this year, even when the Iran conflict started, Garrett. So a couple things happened in March of this year. Number one, Lance got stupid. And oh, by the way, number two, a war broke out. Okay. I don't know that those are correlated, but
one of those is a regular occurrence, right?
Yeah, both. Yeah, actually, but
which happens more often than the other.
So the stock market dropped 9% in March. Bam. Guess what? We're up for the year. So far this year, we're up for the year. So I think it bears watching and kind of keep that in mind. And I get it, Garrett. War is scary. Explosions are scary. And bad news as you doom scroll on your phone is scary. I get it. But here's kind of the big takeaway to me. Imagine a person climbing a mountain. They're climbing the mountain. Here they go, climbing the mountain. The overall trend climbing the mountain is they're going up, right? Now, while this person's climbing the mountain, they're playing with a yo-yo. Okay. Looks kind of like my income. It looks like an EKG. Okay. It's okay. Ribeye steak, ramen noodles, But that person's playing with a yo-yo, and the mountain climber is in a steady trend going up, but it's not a straight line, but the overall trend is going up. So, and what is the media going to focus us on? The yo-yo, of course, always. Okay. And the media is going to focus us on not the mountain climber, but the yo-yo. What should we focus on? Well, I would say the past history of the mountain climber. I think that would be a good place to kind of start looking. So, and I've long professed that the worst thing our industry ever did to our customers was provide up to the minute online account access. Okay. In doing this, Garrett, low down, dirty, dastardly thing we did to our clients. Okay. In doing this, we've caused investors, the same people taking these consumer confidence surveys while they're on their way to the movie theater or on their way to vacation, we've caused individual investors who are notorious about doing the exact wrong thing at the exact wrong time to be even more driven by short-term emotions. And I always want to ask people, because I get these calls all the time. I'm looking at my account online. So I always want to ask people, do you go on to Zillow several times a day, and check the value of your home? Why not? Why wouldn't you do that? Okay. You do it with your stocks, your investments. Why don't you do it with your house? Do you go on to Kelley Blue Book several times a day and look at the value of your car? Well, no, of course not. If you did, you'd be homeless riding a bike, right? So keep that in mind. This is just a check maybe for our emotions. Okay. So in 35 of the last 46 years, you've had at least a 14 drop. You've had a 14.2% drop in the market. Annual returns are positive. The market was up 35 out of 46 years. That's a pretty good win percentage. And so we always have to talk about the bulls and the bears. Okay. So, and we'll talk about kind of what the next slide, what the bears think they think. Okay. So you're always going to have people that love the Dallas Cowboys or hate the Dallas Cowboys, right? You're always going to have Democrats or Republicans. In investing, you're always going to have bulls and you're going to have bears. Okay. Bears are very gloom and doom. They sing the hee-haw song, gloom, despair, agony on me. And they kind of remind us of Eeyore in Winnie the Pooh. Nothing's ever right. Okay. So if you're bearish right now, you're probably thinking, well, we're not going to have any interest rate cuts from the Fed. That's not a good thing. You're probably, in fact, expecting interest rate hikes from the Fed based on what Kevin Warsh is telling us. Okay. You're expecting inflation to remain relatively high, which really hurts that lower end consumer. Remember, inflation is a tax on the poor, on the elderly, those on fixed income, and on savers. Inflation's a tax on them. Right. And lastly, I would think, and maybe legitimately so, you're probably concerned about geopolitical risk. Yeah, we have a ceasefire. No, we don't. Well, we're dropping bombs. So they're dropping bombs. So they're sending drones. We're sending drones. And you see this back and forth between President Trump, the Trump administration, and whatever regime of the day is in charge in Iran. I don't know that we know. I don't think they know. But, you're seeing a lot of geopolitical risk, Iran, Israel, what all's going on in the world. So I get where they would be concerned from a geopolitical standpoint, but I would also refer you back to the previous slide. Okay. These things happen. So let's talk about the bulls. All right. So bulls, generally optimistic people. Okay. And let's talk about what the bulls think they think. So, I often tell people that my crystal ball's in the shop. If you still have one, Garrett, ship it to me. I'll give you my FedEx number, right? But and I can probably tell you still, what the bulls are thinking right now. So if you're a bull, the glass, which is probably filled with champagne, is always half full. Life is good. These people are your eternal optimists. Okay. And fun fact, these people can be equally as annoying as the bears. Okay. They can. But here's what I think the bulls think. Okay. So to be a bull, you have to believe that there will be relative calm in the Middle East. Because of that, they believe you should start seeing lower oil prices, which you are. Because of lower oil prices, inflation will go down. And I think they're probably going to be right about that one, honestly. But they believe that the Fed will not restart interest rate hikes, contrary to kind of what Chairman Warsh hinted at a couple of weeks ago with his press conference after his first Fed meeting. And so with lower inflation, hopefully you see lower interest rates, consumers will spend more. Since the consumer's 2/3 of the economy, this would really help overall economic. I'm not picking sides here, but I really, really hope, the bulls are right about this, Garrett. So we'll finish up here. I thank you guys so much for tuning in. Appreciate you, Garrett, always for putting up with me for a little while. But anyway, love to talk to you. Give us a call. Come see us here at TroopCom, Central Command here on Troop Highway, 3200 Troop Highway in Tyler, Texas. Can be reached at 903-787-8909, 903-787-8909, or on the web on our website, www.lancebrowning.com.
Well, Lance, it's always my pleasure. I enjoy. You're one of the, I almost said funnest. I'm almost positive that's not a word. You're one of the most enjoyable folks that I get to talk with. So it's always my pleasure, and encourage anyone out there listening, give Lance a call. Great dude. I've got a chance to get to know you away from just these conversations too. Really enjoy your friendship and enjoy getting to know you. So always a
Feelings
pleasure,
mutual,
my
brother.
friend. Thank you,
Appreciate you.
sir.
We'll talk soon.
Sounds great. Have a good one. Lance-O-Pedia is for entertainment and educational purposes only. The views and opinions expressed in this show are that of Lance Browning and are not guaranteed to come to fruition. If you have questions about your investments or your financial plans, you should seek a financial professional or give Lance a call at 903-787-8916. We thank you again for watching or listening to the podcast, and we'll see you next time.